This month, we're seeing continued signs of market volatility, fears of runaway inflation, and interest rate uncertainty. Because of this, a lot of investors are wondering whether it's time to follow the old investor tactic to sell in May, to avoid what could be a continued bout of declines. However, for exchange-traded funds or ETFs, investors' hope is not lost. A series of very tactical ETFs have carved out profit potential in an otherwise hostile market and could continue to serve you well in the weeks ahead. If you're looking for a place to put your money that isn't the typical S&P 500 index fund, consider one of these highly tactical ETFs to buy now. Hey, welcome to Stock Market Mate. Today we'll talk about the top 6 ETFs that you should buy this year. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into our first ETF. Number 6. Schwab US Large Cap Growth ETF. If you're interested in broad exposure to the large cap growth segment of the US equity market, look no further than the Schwab US Large Cap Growth ETF. The Schwab US Large Cap Growth ETF holds a Zacks ETF rank of 2, which is based on expected asset class return, expense ratio, and momentum, among other factors. Because of this, Schwab is an excellent option for investors seeking exposure to the style box large cap growth segment of the market. This ETF is a passively managed exchange-traded fund designed to provide a broad exposure to the large-cap growth segment of the U.S. equity market. The fund is sponsored by Charles Schwab. It has amassed assets over $15.57 billion, making it one of the largest ETFs attempting to match the large-cap growth segment of the U.S. equity market. Since cheaper funds tend to produce better results than more expensive funds, assuming all other factors remain equal, it is important for investors to pay attention to an ETF's expense ratio. Annual operating expenses for this ETF are 0.04%, making it one of the least expensive products in the space. Number 5. Vanguard Information Technology ETF. Technology stocks belong in most portfolios, and that makes Vanguard Information Technology ETF a smart choice for investors who want exposure to the IT sector. Vanguard Information Technology ETF is a passively managed exchange-traded fund launched in 2004. While an excellent vehicle for long-term investors, passively managed ETFs are a popular choice among institutional and retail investors due to their low costs, transparency, flexibility, and tax efficiency. The fund is sponsored by Vanguard. It has amassed assets of over $45.49 billion, making it the largest ETF attempting to match the performance of the technology broad segment of the equity market. Annual operating expenses for this ETF are 0.10%, making it one of the least expensive products in the space. It has a 12-month trailing dividend yield of 0.80%. Vanguard Information Technology ETF holds a Zacks ETF rank of 1, which is a strong buy, and this is based on expected asset class return, expense ratio, and momentum, among other factors. This ETF offers the best of both worlds, giving investors a strong collection of proven tech stocks in a single low-cost holding. It will be volatile if the market takes a hit, and the downside can be substantial if investors trade out of blue-chip tech stocks. Because of this, VGT is an outstanding option for investors seeking exposure to the technology ETF segment of the market. Number 4. iShares Russell MidCap Growth ETF. Designed to provide broad exposure to the mid-cap growth segment of the U.S. equity market, the iShares Russell MidCap Growth ETF is a passively managed exchange-traded fund launched in 2001. The fund is sponsored by BlackRock. It has amassed assets of over $14.13 billion, making it the largest ETF attempting to match the mid-cap growth segment of the U.S. equity market. Annual operating expenses for this ETF are 0.23%, putting it on par with most peer products in the space. It has a 12-month trailing dividend yield of 0.35%. iShares Russell MidCap Growth ETF holds a Zacks ETF rank of 2. Because of this ETF is an outstanding option for investors seeking exposure to the style box mid-cap growth segment of the market. But why should you consider mid-cap companies like this? Mid-cap companies with a market capitalization in the range of $2 billion and $10 billion offer investors many things that small and large companies don't, including less risk and higher growth opportunities. These types of companies then have a good balance of stability and growth potential. Number 3. Vanguard Growth Index Fund. Vanguard is world's #1 originator of mutual funds, with $8.1 trillion assets under management as of 2022. With over 40 years of experience, Vanguard's funds have delivered consistent long-term returns. According to the company, 84% of its index funds have performed better than their peer group averages over the past decade. Vanguard index funds can be very cost-effective investments. As of December 31, 2019, Vanguard's average mutual fund expense ratio was 0.10%. Basically, investors make an initial minimum investment, typically around $3,000, and pay annual costs to maintain the fund, known as an expense ratio, based on a small percentage of your cash invested in the fund. Now, it's important to remember that all investments carry risk. and Vanguard index funds are no exception. But Vanguard has a long history of strong performance, and passively investing in index funds is so popular because most actively managed funds fail to consistently outperform the market. Number 2. Vanguard Small Cap ETF. The Vanguard Small Cap ETF is a passively managed exchange-traded fund launched in 2004. The fund is sponsored by Vanguard, and it has amassed assets of over $42.96 billion, making it one of the largest ETFs attempting to match the small cap blend segment of the US equity market. The Vanguard Small Cap ETF also invests in a diversified group of small companies. The fund has an expense ratio of 0.05% and $94 billion in assets under management. Annual operating expenses for this ETF are 0.05%, making it one of the least expensive products in the space. It has a 12-month trailing dividend yield of 1.45%. Vanguard Small Cap ETF holds a Zacks ETF rank of 2, and because of this, VB is a great option for investors seeking exposure to the Stylebox small cap blend segment of the market. Over the last 10 years, the ETF returned 13.79% annually, and over the last 5 years, 13.13%. Its year-to-date return was 11.42%. An increasingly popular option among retail and institutional investors, passively managed ETFs offer low costs, transparency, flexibility, and tax efficiency. They are also excellent vehicles for long-term investors. Number 1. Invesco QQQ Trust SR1. The QQQ stock is the 5th most popular exchange-traded fund in the world, holding more than $170 billion in investors' assets. It tracks the Nasdaq 100 index, which owns the most valuable non-financial stocks on the Nasdaq. QQQ is also the largest ETF that tracks a narrow slice of the stock market. The largest ETF is the Broad SPY stock, which owns all the stocks in the S&P 500. QQQ stock is heavily tilted to mega-cap tech stocks. All of its top 10 holdings are technology or tech-related companies like Amazon.com. Let's briefly talk about the perks of investing in QQQ. Firstly, this ETF has big bull market rewards. If you're feeling bullish right now or want a bullish investment for an asset allocation, the QQQ ETF is a good choice. The QQQ price often goes up more than the S&P 500 does during bull markets, making it useful for sector rotation strategies. Second, it has long-term growth potential. QQQ stock holdings include many companies that develop new technologies, such as computers and zero-emission vehicles. That gives the QQQ ETF more potential for long-term growth. QQQ is also much more diversified across the growth technology sector. This means that it is safer to diversify capital allocation in the tech sector through investment in QQQ as opposed to making individual investments. The QQQ ETF is an excellent buy for frequent bullish traders because of its liquidity and superior performance in bull markets. On the other hand, active traders should be aware that QQQ can lose more than the S&P 500 when it goes down. The QQQ ETF offers buy-and-hold investors low expenses and long-term growth potential with enough diversification to avoid the risks of betting on one company. On the downside, long-term investors in QQQ must deal with sector risk, possible overevaluation, and the absence of small caps. Overall, QQQ can be a good long-term investment as a part of a larger portfolio. Investors are chasing a wide array of objectives this year because the economy is slowly recovering from the pandemic. And this is why we're hoping that each of these ETF picks represents a top-flight way to achieve your goals. And that's about it for today's video. If you found this content helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!